Good morning. We are here today to talk about the financial profile of Spadel SA. Spadel is a Belgian family-owned company created in 1921, specialized in mineral water and soft drinks. It operates in Europe via subsidiaries in Belgium, France, and Bulgaria. The founding family holds 93%, ensuring strong strategic control, but limiting stock liquidity on Euronext Brussels. The company operates in a highly competitive sector. Despite this competitive pressure, Spadel stands out as a leading player in Belgium, where it holds the top position in beverage distribution and ranks second in mineral water production. Spadel's strength is positioned with a vertical integrated model, ensuring efficiency, traceability, and product quality. In contrast to competitors like Nestlé Waters criticized for non-compliant treatment methods, Spadel stands out for its transparency, full compliance with European regulation, and strong commitment to preserving natural water resources. Its B Corp certification across all brands highlights its ESG leadership. Additionally, Spadel follow a local strategy, building trust and reinforce its role as a sustainable regional leader. To sustain its future growth, Spadel will invest 40 million euros in its spa monopoly, including the launch of new product line. In parallel, the group continues its diversification strategy by acquiring an equity stake in the British brand Something and Nothing. With a current valuation of 960 euros and a target price of 233 euros, the stock shows 15.5% potential upside. Spadel is the best suited for long-term investor seeking to preserve capital, while the company offers low risk, steady cash flow, and long-term potential. We therefore recommend buying the stock. The following section of this report will present the detailed arguments and analysis that support this conclusion. We'll first present the financial analysis, followed by the valuation assumptions, then the valuation methodology and results, and finally, the investment risk.
Regarding the financial analysis, assets stayed stable, showing a focus on modernization rather than expansion. Equity rose from 54% to 66%, and all financial debt was eliminated by 2022. The other slide, please. On the income side, turnover dropped in 2020 due to COVID, and profitability decreased in 2022 with the rising costs, but in 2023, the operating margin recovered to 8%, outperforming competitors like valuation. Cash flow was strong with 61 million generated from operations. Investment of 21 million were fully self-financed, leaving 39 million in free cash flow. Financing cash flow was negative due to dividend and leases, in line with Spadel's debt-free and caution strategy. Finally, its financial ratios confirm a low risk profile with high solvency and liquidity, but moderate returns due to the absence of leverage.
So for the forecasting assumptions, so for the sales, considering the track record of acquisitions and investments, combined with the ongoing product diversification and geographic expansion, we estimate an annual growth rate of 7%. For the operating expenses, so looking ahead, we assume that operating costs will remain closely tied to the revenue. So based on historical trends and based also on the company's cost structure, we project operating expenses at a constant 86% of the sales over the forecast period. For the depreciation, so Spadel has consistently invested in sustainability and production infrastructures, which has led to a steady rise in depreciation expenses. So we modeled a depreciation. We modeled the depreciation as a constant 7% of the total sales. For the other operating income and expenses, this item includes a mix of various and partly non-recurring elements. In 2023, it rose to 10.7 million, up to 48% from the previous year. Given its volatility and one-off components, we apply a 17% annual growth rate. For the CapEx, as mentioned before, Spadel announced a strategic 40 million euros investment set to be completed by 2027. So to reflect the timing of this investment, we model capital expenditures dynamically. So from 2025 to 2027, it will be an 8% growth rate. And after 2027, it will be back to 6%. For the working capital requirement, so between 2019 and 2023, Spadel's working capital requirement moved from a positive 1.3 million to a negative 16.8 million. This shift reflects a strong operational efficiency, which improved inventory turnover, etc., etc. So looking ahead, we assume a 2% annual growth in working capital needs. And finally, for the tax rate, we apply a 25% tax rate over the forecast period.
Okay, for this valuation, we use the discounted cash flow method, which estimate the company's value based on the future cash flow expected to generate. The approach consists of two components: an explicit forecast period from 2024 and 2028, and a terminal period starting in 2029. Based on the assumption described earlier, we project the free cash flow to the firm for each year of the forecast period using the following formula. These flows were then discounted back to using the weighted average cost capital KA equal to 3.96%. The terminal value is estimated using the Gordon-Shapiro formula, which assumes constant perpetual growth of free cash flow beyond the explicit forecast period. The enterprise value of Spadel is obtained by summing the two components, discounted free cash flow from 2024 to 2028, and discounted terminal value. Above the valuation multiple, in addition to the discounted cash flow method, we incorporated a market-based valuation using the EBITDA multiple to strengthen the robustness of our final estimate. To derive a comprehensive and balanced valuation, we use a weighted average approach. 70% weight to the DCF valuation, which yielded an EV of more than 1 billion, and 30% weight to the multiple valuation, resulting in an EV of more than 500 million. This combination gives a blended enterprise value of approximately more than 900 million. This blended valuation reflects both Spadel long-term cash flow regeneration potential and its relative market positioning among sector peers.
To assess the risk impacting of Spadel in the future, we can see that they operate with a strong financial foundation and an understanding of managing this risk. And the key area that we identify to have a strategic response is the environmental risk, the economic domain, the operational, and also the regulatory domain. So about environmental, we can see that climate change can have some threaten about water pollution or pollution interruption. And about economic, we can see that consumer purchasing power can decrease with competitions. And about the operational risk, we can see that some resources depletion can occur. And about the regulatory, we can see that there are some regulation now about plastic packaging, and it necessitates investment in sustainability from Spadel. So thank you for your attention. We are at the end of our presentation.